The US housing market has just crashed. Homes are sitting unsold, prices are sliding, and confidence is shot to pieces. And the number one question we all want the answer to, is Australia next? So me, I've been through 2 full boom and bust cycles myself. I've built over $2.2 million worth of equity against a $6 million portfolio. Not Harry Triggerboff, but it'll do. So I've bought at the top multiple times, I've watched values drop and then bounce back up even harder. And my experiences have taught me one key thing, and that's that property doesn't really behave in the way that most people think it does. So in this video today, I'm going to cover what's happening in Australia right now, how it stacks up against the US, and what you can actually do and what it means for you as an investor. So yes, all it takes is a quick Google and you can see all the headlines about the US housing market crash, but let's dig a bit deeper. Florida is a great example, so let's dive into some of the Redfin data. In July 2025, the state's median home price was down 1.3% year on year. So from about $408,000 to $404,000 US dollars. At the same time, homes that were sold fell roughly 8.7%, while inventory rose 7.5%, meaning buyers suddenly had more choice than before. And if we zoom in even further, some metropolitan areas are seeing even sharper drops. For example, in West Palm Beach, prices have fallen more than 4.9% year on year, while in Jacksonville, they're down about 3.1%. So in essence, properties are taking longer to shift and longer to sell on market. Days on market is sitting at a staggering 93 days. But I mean, usually days on market here, we want it to be 25, 30 days, but that's about 18 days longer than it was last year in the same location. So yes, of course, the market is cool, but this isn't just some overnight free fall or plummeting. It's very, very gradual. So what we're really seeing is slower sales, a rise in listings, and sellers simply having to reduce their asking prices, which is really just the sign of a correction as opposed to a crash. And it is very specific and poignant in specific areas. But then the obvious question is, could that happen here? Could Australia experience the same thing? We're going through a very bullish or a boom time in the market. Could there be a correction or a crash incoming? Or are our fundamentals just different? What is different about the Australian property market than with the US? So to answer that, we're going to dive into how does the Australian property market actually behave and how does it differ from the US market, and does it differ from the US market? But before we get into that, I've put together a free property investment checklist that you can download. It dives into what to look for in terms of red flags, what are the due diligence points that you should be looking at when you're buying a property, looking at the right location, supply and demand factors. These will all be really helpful for you if you are considering getting into the property market or expanding your portfolio. And you can download it in the link in the description. So one of the biggest misconceptions that exists in general is that property behaves like the share market, that it is like shares. It is absolutely not. People think that property behaves fast and brutal and crashes and sees big peaks and troughs, but they are completely missing the fundamentals of the asset class that is property and why it behaves differently to shares. So I'll give you an example. I bought a property here in 2021 in Sydney. I bought right at the top of the market. Values decreased by about 10%, but since then they've bounced back 40% as of now, as of 2025. So here is why property is fundamentally different from shares and behaves very differently to the share market. Number one, shares are liquid, meaning you can go on your app on IG or eToro, whatever it is, and you can hit sell almost instantaneously, and so can the rest of the market, right? Panic sell, everyone dumps their shares because of news about a CEO or about the market or what have you. All of a sudden, values plummet instantaneously because shares are very liquid. They are like cash. They can be liquidated almost instantaneously and you'd have your money within a few days. Property, by definition, is a very illiquid asset, meaning not only does it take you a long time to sell it, it is a very costly and time-consuming process. You cannot simply push a button and sell overnight, meaning that if there is a downturn, things are much more drawn out. Typically, from start to finish, it will take someone anywhere from a minimum of 3 to 6 months before they decide thinking about selling their home to actually selling it and that property selling and then being transferred into the new owner's name. So what this means is that the property market, generally speaking, goes through a very gradual decline, right? 0.2, 0.3, 0.5% per month over a course of 12 months, which would maybe get you a 6% downturn, for example. The other thing to note that's really, really important is that property has utility, right? People live in their homes. They do not simply use them for investment. 65% of people that own property live in it, meaning that in times of a recession or economic uncertainty or turmoil, people are going to sell their left kidney before they sell their home, right? They'll sell their cars, they'll sell their gadgets, their computers, and they will do everything they possibly can to protect their home, which in turn protects supply. Whereas stocks are purely an asset for investment, right? They're purely there for people to make money. So, side lesson here, we don't want to be investing in areas where it's heavy with landlords or investors or renters. We want to be investing in areas where it's owner-occupier dominated, because that protects us against downside risk. So the lesson here is that property runs in cycles. It's not sudden collapses and crashes and plummeting of values overnight. Not in the same way that the stock market does. The reverse of that is also true. Property doesn't peak overnight. It doesn't boom overnight, right? Booms are also more drawn out, and booms for a period of 12 to 18 month periods or 24 month periods. Whereas when you see the boom in the stock market, it definitely doesn't last anywhere near as long. So it is true for both boom and bust, and liquidity and illiquidity apply in both scenarios. So what this means is that the fear is actually the thing that gets in people's way more than anything. The fear of the crash itself is actually worse than the crash itself actually is, and it stops people from getting in, from investing, and from compounding over the long term, which is the true value of what you get out of the property market. The thing that people get wrong the most is that a property crash will wipe them out financially. But the reality is that history tells us otherwise. The downturns here in Australia are something like 5 to 15%, and they're stretched out over a matter of years, not all of a sudden crashes that just plummet overnight 40%. And one of the hardest things to do is to time the bottom. Everyone misses it. Most people do. I might not, because I know what the hell I'm doing, but you probably don't. Sorry, I'm joking. So the lesson here is that the real winners are the long-term buy and hold investors. They do not let these little downturns shake their confidence in the market. If anything, they maybe see them as opportunities. So if you let fear take a hold of you, here is what you could actually miss out on. You guessed it, it's the missed opportunity for growth. The real myth here is that waiting for the downturn to occur or to try and time the market is the thing that is going to save you money, but that couldn't be further from the truth. And the truth is that 6% average growth on a $700,000 property gets you a $42,000 gain in year one, let alone the compounding that occurs. So if you sit out of the market for 2 to 3 years, waiting for this impending doom and gloom, this impending crash, you could be missing out on $85,000 to $135,000, $140,000 in missed compound growth. That is just in that short period of time. So ultimately, the real takeaway here is that waiting usually, 9 times out of 10, is going to cost you more than taking action. And remember, it is not just the growth that you are losing, it is also inflation acting against your dollar. Your cash is eroding. Your cash is eroding at a minimum of 3 to 4% per year against inflation. And also remember, the building costs keep rising, right? So the replacement value of these properties is only getting more expensive. So naturally, property will move in line with these cost increases. Construction CPI growth is typically 3 to 4% a year as well. And while your savings and your cash is losing value and shrinking, your borrowing capacity could be as well. Arguably, we are going to have periods where rates are increased and therefore housing might take a hit because people can borrow less, but that is exactly the point. Your borrowing power is also taking a hit at the same time that the market is taking a hit. So by waiting, you might actually end up qualifying for less or the same, or it doesn't make a huge difference, rather than more. So take into consideration the borrowing or the lending implications as well, not just what the market is doing. That is a one-dimensional view. And finally, you've probably heard the saying, it's not about timing the market, it's about time in the market. And what that is really referring to is the power of compounding. Compounding only works with time. Every year lost is another year of growth, and compounded growth lost. And just go and Google compound interest calculator and see what I mean. Chuck in $1 million investment, compound that over 10 or 15 years, and you'll get my point. So the sooner you are in the market, or the more time you have in the market, the more time that compounding has to work for you. You've probably heard the saying by Warren Buffett, compounding is the 8th wonder of the world, and he is not wrong. So if you want a step-by-step way to invest with confidence and protect yourself, check out my free property investment checklist. That's going to give you the confidence and the conviction to stop second-guessing yourself and help you enter the property market sooner rather than later. So thanks for tuning in. That's where things stand right now in terms of the state of the Australian property market. Make sure to like, share, and subscribe. Am I an influencer? No, I'm not an influencer. I'll be running these sorts of videos at least once a week. So happy hunting, and may the odds ever be in your favor.